Joining us right now in a Squawk exclusive interview ahead of his first appearance on a conference call with analysts is Exxon Mobil's chairman and CEO, Darren Woods. And Darren, thank you so much for being with us today.
Good to be with you, Becky. Thank you.
The earnings per share were substantially better than the street had been expecting. Revenue, I realize, is a different game because there are 18 analysts that put in requests or put in numbers that they think you're going to hit for earnings. Only 5 will even give a guess when it comes to revenue. But the revenue number was a little below what they expected. So how did you manage to beat with earnings in such a handy way when revenue wasn't necessarily what they thought it was going to be? What kind of screws did you turn to get those results?
Well, we had a really good quarter, and you may have recalled in the beginning of 2018, we reconfigured our downstream organization. Since the merger of Exxon and Mobil, we had put ourselves into a functional company construct. In the beginning of 2018, we organized ourselves along value chain and challenged ourselves to make sure that we were maximizing value all along that value chain. And the downstream delivered significant results in the fourth quarter, taking advantage of our integrated presence across all of the businesses that we operate. So I think a big contributor to that beat is how we optimized our business from end to end, from well all the way through production into our marketing organization.
You are now continuing with that reorganization. You've got plans to reorganize the exploration business, the upstream business, from 7 different businesses into 3. What does that mean, and why are you doing this?
Well, you know, I think when we merged with Exxon and Mobil, we had a lot of opportunities to focus on getting the best out of both of those organizations, bring them together, best practices, best processes all across this global platform. We've done a great job at that. I think it's brought a lot of value to the bottom line. We're going to hang on to the functional excellence that we created through that process. And the next step now is to organize ourselves to make sure that we're capturing all the value that we can from the market. And so we're organizing the upstream business along value chains so that our people can see that business and optimize it again from end to end, from production, from resource development to production down through marketing. So we're real excited about that. It's a very similar concept to what we did in the downstream. Great results in the downstream, and we are very, very excited about the opportunity and the upstream to do the same.
Darren, one of the highlights from the release that we're just going through is that fourth quarter liquids production was up 4% year over year, and that's largely because of growth in the Permian. How much are you investing in the Permian? Where are you kind of seeing the fruits of that, and what do you expect to have happen this year?
Well, we're real excited about the opportunity in the Permian. We had an acquisition back in 2017. And when we stepped back and looked at what we could do in the unconventional space, I think Exxon Mobil can go into that market, into that resource play, and take a very different approach than a lot of the players that are out there today, leveraging the strength of our large global organization, our project development, the scale, bringing our technology to bear in there. And so we're taking a very different approach to the development in the Permian, putting a long-term plan in place to develop unconventional resources at scale. I think that's something unique to our company, unique to our capabilities. It's going to bring a different type of production, a different game to the unconventional space. And I think, again, we're going to demonstrate some significant value accretion through that process.
With that additional technology, with what you're doing, what does that mean in terms of what you need the price of oil to be for it to be profitable to be pumping oil from the Permian Basin?
Well, our goal is to make sure that we are going to be successful and like the returns that we're getting on those investments in very low price environments. So all the work that we've been doing in the Permian and really across our whole portfolio of production is to make sure that we're bringing to bear the competitive advantages that we have as a company and bringing those into our projects so that our break-even costs are low and we're getting good returns even at low oil prices. In the Permian, we're below $40.
Wow.
Below $40, down $35 a barrel, we think we're going to see some very good returns even at those levels. I mean, of course, the market's higher than that. That's upside for us. That's
a big game changer given where we saw oil prices fall last year. Obviously, January's been a good month for oil prices if you're somebody who's a producer. We've seen a big rebound of 18%. What do you think happened last year with that collapse in oil prices? Was that a picture of supply or was it a picture of weaker demand?
No, I think if you look at demand's been pretty robust all through last year, and we anticipate going into this year. May come off a little bit, but we'll continue to see a reasonably healthy demand. I think that was more of a supply play, and obviously it's difficult to kind of always strike the balance in real time. think the market had anticipated the Iranian sanctions and what came off, what production would come off there. With some of the waivers, that may have been less than anticipated. OPEC may have produced more than they had wanted to in terms of keeping that market balanced, and it just took a little while for the market to recorrect.
Are you fearful that demand could soften further this year? We just got a China manufacturing number out, which was below 50 contraction territory. I think it's the worst since Feb 2016, and the data out of the Eurozone has not been great either recently.
Well, as we looked at 2019, as we were coming into 2019, we anticipated some economic slowdown. Still expansionary, but some slowdown there. Frankly, we don't run the business or try to build it on a projected demand or projected oil price because, as you know, so many different variables are going to affect that balance and affect the pricing. So across the portfolio, we're looking at developing resources at the lowest cost of supply to industry, and then let the prices go where the prices go and where the supply-demand balances take them, and then make sure that we're successful irrespective of what price environment we find ourselves in.
Great to have you on, Darren. This is Joe Kernan, and I just feel like I have to. My co-anchor Andrew's not in today. I mean, if I don't do an ESG, virtue question, I just feel like I'm not. I got Exxon on, but my take on pressure and to be a good corporate, in terms of society, to be a good corporate citizen. I think it's very complicated, and I just wonder what your views are. If someone were to try to force you to, not bring hydrocarbons out of the ground, or to move more quickly to a different form of renewables that we've seen. I just saw that over in some country in Europe, there was a deal signed where they had to buy a certain amount of wind, and it's like 10 or 20 times more expensive than what's available with natural gas now, but they have a contract, so taxpayers are paying for it. I mean, do you get swayed to change what Exxon has done over years and years, and that is oil and gas exploration? Do you feel the pressure to do something different now? We might not have had the great renaissance over the past 5 years in oil and gas if you had.
Well, Joe, as we look forward at the future, we base all of our plans on an annual process that we go through, anticipating, forecasting, looking at what the supply-demand balances are going to be, and then base our business on that. I mean, the reality is concerns about climate and the drive to reduce CO2 emissions with our energy sources. We think that's a legitimate objective. I mean, our company is a science and technology company. We have evolved with consumer demand and preferences over the course of our 135-year history. We anticipate continuing to do that. So we're pretty comfortable with this drive and the desire and the aspirations of societies to move to lower emission sources of energy. I think the challenge there is finding the technology to allow the world to do that. Today, the solution set that we have is not sufficient to achieve that goal. As a science and technology company, we're very focused on making investments to see if we can't fill those gaps and provide some solutions that are a win-win solution, provide energy at affordable and reliable to consumers all around the world and populations that desperately need them to raise economic growth and people's prosperity, and at the same time reducing emissions. We think technology is going to solve that. We think we've got the ability to help with that.
The hydrocarbons are going to be part of the mix, though. I mean, 50 years from now.
Absolutely.
Maybe cleaner, maybe whatever, however you want to do it, but just, you just can't can't go with the prevailing, whatever is in fashion at any given time. It's cold in the Midwest. I'm glad we have some people that are still getting heat from fossil fuels, or else it'd be.
I think, Joe, people don't fully appreciate just the size of the energy system all around the world. It is an enormous system, and it will take years
Someone told me
and decades to transition.
I heard from someone yesterday that said, fossil fuel, we got it. And it's like, do you really think fossil fuels have been a negative for mankind over the past 300 years? I mean, that is the most preposterous. If you like being cold and warm and having cooked food, I guess you need it. Anyway, sorry.
Darren, I want to thank you very much for your time. Darren Woods is the chairman and CEO of Exxon Mobil. Exxon shares, again, up by about 2.5% after the company came in with earnings of $1.41 versus the 108 the street was expecting.